Thanks for joining us today. This is Greg for Teslafaninsight, and this is an introduction to options trading when it comes to all stocks and other instruments, but especially Tesla. Now, I will admit that this is a kind of a bad show to start because I'm actually in my car and I happen to be shooting at a really cool location. We'll show you the video afterwards, but it's one of the few days during the summer that's kind of cool because there's a heavy breeze and it's totally awesome. So this should be done indoors carefully. It's not. And so to begin with, I apologize for that, but quality of execution will be on point. And I chose to be in the car because the wind speeds are up at a consistent 15 miles an hour and would big time affect how my sound is, even though I am doing the plug-in mic here for Apple. The other reticence I had about this show is that we actually do what's called trade consulting. So we bill you on a minimum of, half hour, but, hour, multiple hours and up in terms of understanding how to apply options to your trading strategy. So part of my reticence here was that we typically get paid for doing stuff like this, but we're doing it free across the channel right now. I would appreciate your taking time either on PayPal or Patreon or another space to, send us $3 to $5 if you think the information on the show was useful, because it incentivizes us to do more shows like this. So again, please support us by chipping in a few dollars to support what we're doing with the show, which is a not charged for show. And our series is typically between $50 and $100 for options trading training. So for our intro today, what I'm actually going to do is there are obviously a lot of elements to how options operate, how to implement them well, etc. One of the things I've always found interesting is in math, there's a concept called a word problem. So people will just throw you a formula, learn the formula, apply it, we're done. Now, I'm not going that route because when you're learning stuff, I want to say organically, it allows you to look for the edges in ways to leverage that information to do other trading, work with those instruments in other environments. So today I have kind of three components of what I'm going to be teaching. The first thing I'm going to do is illustrate options to you when it comes to home ownership. The second phase of this show is I'm going to illustrate options to you in the form of what I call the Racetrack Deal. And then after we go through those two, I'm then going to do sort of a global understanding of the data points that you use when you're trading options, particularly on stocks like Tesla. And a lot of the general concepts are going to rotate off of points number 1 and 2. So what I wanted to cover today is that first, there's a concept called buying a house. So if you've purchased a home, what you didn't realize was you were trading options. What do I mean by that? Well, think about it this way. Let's say there's a homeowner and they bought a house for $100,000, okay? When you went to see that house, it's likely that you have to put $5,000 in earnest money down, and that $5,000 will likely be part of that $5K you put down will likely end up being part of the down payment for the house. But for giggles, let's say your earnest money was $5,000 and you now control a $100,000 asset. Now, what you did there was you actually traded an option, because what you just told the homeowner after you put the $5,000 down is, look, I want 90 days. There's a gentleman who's shaving the lawn and I don't want his machine to affect, your ability to hear me, so I'm precautionary move here. So what I wanted to review here is the fact that without realizing it, you've been trading options as well, and you understand it. So what we did was we have a $100,000 house. We've put $5,000 in earnest money. What does that mean? Well, that means that now that you've secured the house with the earnest money, if we eliminate things like due diligence on inspections and so forth, let's just make it a very simple deal where you put your $5,000 down, you have 90 days to complete that loan, and then you now own that home. So in this scenario, the reason or how we would leverage this information to show you how options work is I'm going to give you a quick exam because I know you've already done a house purchase, so I don't have to worry about that. The exam I'm going to give you is this. If $5,000 in earnest money gives you, it gives you 45 days to complete your loan, what if you said, okay, it's 45 days for $5,000 to complete my loan. Let's say you told the homeowner, look, I actually want 90 days to complete this loan, okay? Now, I'm gonna stop for a second and ask you to stop the tape. Think through what the answer is to this, because it's important in your training that you understand. Correct. The answer is if 45 days equals $5,000, then you're getting 90 days to complete this loan, which is more time than usual, is going to cost you more. In theory, in this example, I'm giving you double. So if you want 90 days to complete this loan in a hot real estate market, they're going to charge you $10,000. Now, let's put out another option scenario here as an experiment. What if you had the $100,000 in your account and you decided that, hey, I want to buy this thing and I have cash and I'm going to move fast on this deal. The question is, how much earnest money do you have to put down? Correct, the answer is zero because you're just paying for the thing right outright and you don't need earnest money. And so what this illustrates is that in options trading, the more time you get, i.e. time value for that deal, the extra time you have to pay for. So your buying time is part of the parameters for measurement of the price of an option. So right now I'm going to stop to ask you to write down 3 data points. There are 3 components to the pricing of an option. Component number 1 is how much time is associated prior to the option expiring. So if we go back to the house example, what I said to you was, what if you chose to write a check right away? Do you have to do an earnest check? No. What if you got 45 days? How much was that? $5,000. What if you got 90 days? That would be $10K. So without me telling you the answer or making another question, if you said, hey, I really love this house, I can't do anything for a year, but I do want to buy it, what actually would happen is we'd go into another discussion about, hey, what if you get a year to do this deal, right? How much is that going to cost? Well, that's what happens with options. One of the ways you get more security with the option and it not expiring is by simply using or buying more time on that option. So again, there are 3 components. Number 1 is how much time is there before the option expires. Number 2, proximity to a certain price. That has nothing to do with houses. In this case, our option is on a house at a price at $100,000, right? And so, unlike a stock price where the closer you are to the stock price, the higher the price of the option, we're kind of moving away sort of from that, and we seem to be getting invaded here. So I'm bringing this up because what I wanted to do is establish the components of how you determine what an option's value will be. So I've covered with you time value, I've covered with you proximity to price, And the third component is something called implied volatility. What that means is that one of the reasons why Tesla is one of the most heavily traded stocks and slash options is that every day for the last 2 weeks and probably for the last 6 months, there are probably only 10 stocks that have more volatility than Tesla does. So what that means is that you have the potential for making a lot of money if you can figure out which way the stock is going, because you're trading the options, which give you some really nice returns in the process. So I bring this up today because I now want to go into a second real estate transaction that illustrates the power of options prior to getting to our sort of final destination today, which is sort of carefully reviewing options pricing and finishing up off our intro. So there's a deal that I like to use as a guide for people, and I call it the Racetrack Deal. So there's a place called San Francisco, and there's actually a racetrack I believe called Bay Meadows right next to San Francisco Airport. So I want to say 8 or 9 years ago, or maybe 10, there was a deal that happened where the owners of the racetrack decided that they wanted to sell 100 acres of land abutting 101, which is a major freeway, right in front of the racetrack. Now, this location is one of the most valuable locations anywhere in the world, and the reason is that it's about a mile south of San Francisco Airport, and it's right in front of this racetrack. Well, what's also interesting about it is that one of the biggest hindrances to development is traffic impact on neighborhoods. And so what's really cool about this location was that because it sat next to a major freeway already, and there's a shopping mall around the corner from it, the neighbors sort of bitching about whether or not their traffic would be impacted by this thing being built out wouldn't be there, because the traffic is already there at the mall behind them. There's also traffic associated with the racetrack. So the objections to building seem to be under control. So what happened was there was a deal that was struck between the racetrack and a corporate entity. It was a group of folks. GE Capital sort of led the group. And what they concluded was that it would take 5 years for them to complete this transaction. At the 5-year mark, the buyers would be obliged to pay $25 million for that piece of property. As a good faith option, they were required to put down $1 million to control 100 acres for 5 years as an option, so they could go through the process of figuring out, all the legals, all the permits, etc., to be able to build on that property. So again, to review the basic numbers, we have a property that's valued at $25 million once it's completed encumbrances or rules. The down payment to get 5 years to get this deal done was $1 million. So what happened was, after completing this part of the transaction, they got some of the best real estate attorneys in the world on it. And what these guys did was they were able to get permission to build within a year of the initiation of this deal. So the next thing that happened was that those individuals, because they'd gotten it through the first phase, actually completed all the pre-development activity that was required for this plot of land in terms of permits, in terms of city, the whole 9 yards. Once they completed this, instead of it taking 5 years, it only took 1 year, they approached several major developers. And what then happened was the developers were like, hey, we'll give you $100 million for that piece of land, because if you look at the per acre value of this thing in Silicon Valley, is $100 million before they even stuck a shovel in the ground. So what then happened is the people who put this deal together immediately sold for $100 million. Within the same room as this transaction was occurring, they shipped $25 million to the racetrack to pay for the original agreement, and then sold the land to the developer. Now, if you land in San Francisco, you live in that area, take a look at that project. It has a Whole Foods in it. It has housing, I believe some offices. It's a great piece for a whole bunch of reasons. And it was an amazingly great, well done deal. So let's review this. In this case, we were talking about getting 45 days to build, right? Then we talked about what about 90 days? What about no days? How would all those numbers work out? Well, what if we got 5 years? How much would that cost to get a transaction done? So how this deal played out is a great learning tool, I think, to leverage knowledge to be able to do transactions, including options or even, to mess with housing development. So I bring up this deal to you because one of the reasons people mess with options is the fact that, hey, wait a second, if I could do a deal where I put down $1 million and get back $75 million in 1 year, would you do that deal? That's what's been going on with Tesla. People are putting down 100 grand on Tesla on what are called leaps. So there's certain options that give you 1 year before this thing is exercised. And so if you think Tesla is doing well, but things are rocky right now, but next year they'll be blazing, guess what? You want a leap. And a leap is a fairly secure way to invest because it gives you a lot of time before it expires, so you don't have to worry about what's going to happen tomorrow or the day after. You can relax. Now, an excellent question that you'll pose is, now wait a second, a leap sounds like I just bought the stock because I could just hold the stock for as long as I want rather than having a fixed time on the option. Absolutely. The difference, though, is the acceleration in value on options is a lot faster than the stock. And that's why people sort of introduce them to the risk of managing options in the process. So I would argue that leaps are the safest options method to consider. And leaps have a whole bunch of other interesting parameters. And one of the best parameters is because you've held that sucker for at least a year, you now have a reduction in capital gains tax because it's a long-term holding versus a lot of options traders tend to trade within the week, within a couple of weeks, within a month, and they get hit with a big tax bill after they sell, even if there was a nice profit. Whereas that tax is a lot lower if you hold for a year, hence making leaps a more attractive thing to consider purchasing. So, quick question. If we're dealing with leap, we're dealing with options, you like Tesla's prospects over the next couple of years, what should you consider buying? Exactly. Maybe a 650 leap, maybe a 700 leap, maybe an 800 leap. What that's saying is that you think a year from now, Tesla's going to get to 650 or 700 or 800. And you can push this out a year. Those options would be very expensive, but they'd be very safe and driven by the research you've done to understand how and why Tesla is a great investment. So, options can get very complex in terms of how long you could have an option that expires this Friday or an option that expires 2 years from now. There are a whole bunch of interesting transactions that have occurred that show the power of options in terms of making a lot of money quickly or potentially losing it. And so we could definitely get into that. For our intro today, as you know, there are a lot of people that have made a ton of money, including watching our show and understanding some of the techniques we've introduced and understanding what is and isn't going on with Tesla's calls or Tesla stock and then its calls and puts. I wanted to do kind of a general intro today to options, kind of what they are, how they are, etc. The final component of what I wanted to cover today is why do options even exist? And the answer is there are a lot of large portfolio managers who own large amounts of shares, and they were fearful that they were going to lose all their money if things went crazy up or down in a short period of time. And so these instruments were developed as a way to put insurance in on large portfolios. So you've probably heard me say this to you before, and that is that you want to build a calendar if you're investing or trading Tesla of the entire year where there are certain days of the year that you want to be very mindful of. Number one is the 4 days a year when the production for the previous quarter was announced. So one of those days is coming up. I believe it's, it'll be 2 days after the quarter ends. So it should be the end of next week. And right now it's the 22nd of June. So like the 2nd of July or that business day when they'll release that information. It's going to affect the stock price greatly, and you want to be aware of those. Why do you want to be aware? Because if you have more than $1 million worth of Tesla shares, it behooves you to engage in what's called insuring your account. What do I mean by that? Well, in the case of a house, let's say the housing prices were falling, right? What can you do about it? All you can do is sell the property and get out of it as soon as you can. You can't really hedge yourself against that declining price. In the case of stocks, especially like Tesla, the stock price is up dramatically. You can actually buy insurance against the drop potentially in the stock price by buying what's called a hedge, which is a hedge here would be a put versus a call. And so one of the things I encourage people to consider, if you're toting more than $1 million in Tesla stock, I highly recommend that you consider at minimum a 1% of value for a portfolio purchase to make sure that you do not end up losing huge amounts of value. So the question that comes up is, should you use a hedge? If you're a long-term holder, probably not. But Tesla's had those periods where stock was at $700 or $800, it's falling $200. That 1% or 10K in value that you've put out there will have done one of two things. Either one, it'll go down in value because the stock price is rising, or two, it'll go up in value because the stock price is falling. And so basically it's an insurance policy against the value of your portfolio. I think it's prudent anytime you have big news anticipated for Tesla, because you could have a monster up, which would be great because your stock increases in value, or you could have a monster down in price, which would be bad because the value of your stock has declined. But wait a second, you had your insurance policy where you at least get some money. Now, some people that are really serious about it will get 10% insurance or 15% of portfolio insurance. That way, if the drop is truly dramatic, you actually get paid back a lot of money, perhaps all the money that you might have lost if the stock price fell. So again, these are some of the techniques and tools that sort of roll off of your ability to trade options, and therefore it's a really good thing to consider. So what we covered today is we kind of went through two real estate transactions, illustrating the fact that without realizing you actually been trading options, and therefore you might have a better command of the environment than you thought you did. The second thing that we covered today is, the core pricing process for how these instruments work. Remember, pricing methods are, delta or volatility, proximity to price, and how much time before that option expires. The third thing we covered is if you have a large portfolio, it's very wise, as you've seen with Tesla stock price, to consider putting 1 to 5% of the value of your portfolio out there as a hedge or puts to protect your portfolio. Now, obviously, there's a whole bunch of other things you can do with options. We'll cover that in our subsequent shows that are focused on this, but I wanted to encourage you to consider liking and subscribing to our show, number one, and joining us on Patreon. The second thing I wanted to suggest is please take time to at least ship us $3 to $5 on our Patreon, which is listed below, or in PayPal to show some appreciation for us sharing with you information you wouldn't have had otherwise. That'll be very helpful permanently for all that you're doing. And you can also show this to other individuals that don't know about investing very well, but want to start the process of learning options. If you do like this, we do have sort of step forward of this more intensive looks at how to deal with options, how to deal with Tesla's options, etc., as part of what we do. And we look forward to your comments about that here. At any rate, we've gone longer than we usually do today. We're looking forward to your comments. This is Greg for Teslafaninsight. Tschüss, German, au revoir, French, Lehitro, Hebrew, Choda Hafez, Farsi, Zdravstvuyte, Russian, Ni Hao Ma, Chinese, Konbanwa, Japanese. And hey do Swedish, our friends, good day. In Australia, namaste, our friends. In India, have a great day. Bye for now. And thanks once again for joining us. And we look forward to your feedback so we'll know whether or not to do more shows of this ilk.